Thank you for joining us today. We all certainly appreciate your time and attention in learning more about how your investments are managed at Summitry. My name is Cynthia Duncan, and I am today's moderator and a senior financial advisor at the firm. We see it in the headlines and have experienced it in our accounts. This has been one of the worst starts to a year in market history. Many of us have been through this before, during the tech bubble in 2000, or the financial crisis in 2008, or more recently when the COVID lockdown began in 2020. These were certainly all scary times, but by following sound investment principles and staying the course, most of us have exited these periods whole, if not better off than where we started. These are the lessons we must remember today. Our objective for today is straightforward. We want to provide perspective on the real concerns about inflation and how your portfolio is positioned in the event of a recession. Here is what you can expect during today's webinar. We will begin by exploring inflation and interest rates and putting these into historical context. Next, we will discuss the framework for investing during a recession and how this impacts your current holdings. Then we will look at recent changes in the portfolio, including a deeper look at Netflix and Amazon. And last, we look forward to answering your questions and hearing what is on your mind. You may submit a question at any time during the presentation by using the Q&A icon at the bottom of your screen. And I would also like to let everyone know that a recording of this session will also be available after today's presentation. So let's get started and introduce our investment team here at Summitry. First, we have Colin Higgins, Chief Executive Officer, Kurt Hofer, CFA, Chief Strategy Officer, Michael Kahn, CFA, Director of Research and Portfolio Manager, Matt Gordon, CFA, Senior Equity Analyst and Portfolio Manager, Jack Zhao, CFA, Senior Equity Analyst, and Jason Yu, CFA, Associate Equity Analyst. Now I'd like to hand it over to Kurt to begin today's presentation. Kurt?
All right, super. Thank you so much, Cynthia. Let's go to the next slide, please. So we've been experiencing some dramatic shifts in our economy since COVID made its appearance in 2020. From the standpoint of our discussion today, we can separate the past couple of years into two periods. The first phase saw our government take emergency measures to counter the deep recessionary effect of the COVID virus. The stimulus worked, perhaps better than anyone had imagined. The second phase, which we're in now, is focused on a fight against inflation, which was the result of many factors, but mostly because of the emergency measures taken in phase one. The gray line represents the S&P 500 over that time. Investors in stocks are better off today than prior to COVID, but the recent decline suggests that the market has discounted a slowdown in the economy. We'll talk about this more in a moment. Let's turn the page. So Milton Friedman's proposition that's outlined in this quote said that inflation is a monetary phenomenon caused by too much money chasing too few goods and services. And his proposed cure were the basis for the Federal Reserve under Paul Volcker to address the ravages of inflation in the 1970s and early 1980s, and appears to be driving the Federal Reserve decisions today. The key challenge we face now is that tightening money supply is harsh medicine, which may lead our economy into a recession. Since recessions are not friendly to the stock market overall, our job as investors and as protectors of your wealth is to operate with discipline. First, we believe that research can identify those companies that are more economically resilient than the average business. We can focus our investment dollars there. Second, we maintain that a long-term orientation will win. Capitalism corrects its own excesses. A focus on business fundamentals over long-term economic cycles will protect us from making errors in judgment and position us for gains. Let's go to the next slide. Inflation has reached levels in the US that we haven't seen since the late 1980s. since the early 1980s, actually. This is obviously concerning. For those of us who remember the 1970s, the loss in purchasing power caused by inflation led to the stagnation of the US economy and high unemployment. We don't think we're headed back there for several reasons, including the reduced role of imported energy, the substantially more flexible labor force, a better recognition by the Federal Reserve of the forces that cause and sustain inflation, and better knowledge of the tools that it can use to fight it. And this fight has begun. Let's go to the next slide. This chart illustrates why it's so important to fight inflation. If we look back to previous bouts with inflation, it seems fairly clear that they're associated with broader problems in the economy. The inflation chart is the same as on the previous slide, but here we overlay real economic growth and contraction. Some of the more notable spikes in inflation were closely followed by declines in real GDP. Let's go to the next slide. We've had a glimpse over the period since COVID of how impactful actions by the Federal Reserve can be. They fueled gains in risk assets with their loose monetary policies. Now they're countering the inflationary pressures with tighter monetary policy. The top chart here shows the amount by which Fed members have changed their views in just the past several months regarding inflation, with the dotted area to the left representing expectations of the various members of the Federal Open Market Committee in December, and the solid bars on the right representing the revised views of inflation. Despite having access to the best and most timely economic information available, they were clearly caught off guard. The bottom chart demonstrates the shift in policy in reaction to inflationary pressures. The Fed funds rate is one of the key policy tools to slow an overheated economy and to ward off inflation. The members of the committee have shifted their views of the appropriate rate meaningfully higher to put the brakes on an economy that is running hot. Let's go to the next slide. So now for some good news. This very visible battle being waged by the Fed may already be having a positive effect. The prices of all bonds that freely trade in the markets embed an inflation expectation. If inflation expectations are high, then bond investors will demand to be compensated for it. One way to quantify this inflation expectation is to look at the difference in yields of ordinary Treasury securities and yields on TIPS, or Treasury inflation protected securities. It is that difference, the embedded inflation expectation, that's shown here. The top line shows inflation expectations embedded in 5-year Treasuries, and the bottom line shows inflation expectations embedded in 10-year Treasury securities. As you can see, after moving dramatically up during 2021 and the early part of this year, the trend now seems to be heading in the other direction. This suggests that the bond market is pricing in roughly a 3% average inflation over 5 years and about 2.5% inflation over 10 years. That's a far cry lower than the most recent inflation readings of over 6% growth in core CPI. Fed talk and Fed action may be working. Let's go to the next slide. Recessions have invariably had a negative impact on markets. It stands to reason. Consumers and businesses retrench, corporate earnings decline. Weaker businesses with too much debt or unresilient business models may even fail. There's a lot of data on this chart which looks at market activity around the 12 recessions that have occurred since the end of World War II, so bear with me. The mean and median declines in the S&P 500 during these recessions are 28% and 23% respectively. So those red numbers that you see there. Some of the market declines have been deeper, others not so deep, depending on a whole host of factors. What's interesting is that after markets reached their lowest point, the recoveries tended to be fast and furious. The next columns showed that the mean and the median recoveries after 6 months were 28 and 27% respectively, and after 12 months, 39 and 36% respectively. The far right column speaks to the length of time it took to go from the market lows to its previous heights. In other words, to achieve a complete market recovery. The experience varies widely, but at times has been extremely short. It's important to remember that the market is forward-looking and it doesn't wait for negative economic data to drop. and it doesn't wait for improving economic data to recover. When thinking about our current market, the decline that we have seen already from the S&P 500's January peak are substantial. That's in that bottom row, that negative 19%. It's not terribly far off from previous experiences in recessions. So here's the point. It suggests to us that the markets may already have discounted a recession with a significant change in prices that we've experienced. Are we at the bottom? We can't know. But the risk from here may be more to the upside than to the downside, if previous experience is any guide. Now, Jack, why don't you take it from here?
Thanks, Kurt. As we suggested earlier, there are signs that the principal concern that we have as investors today, and that this crisis, like many before it, will pass. Uncertainty creates volatility in the equity markets. We've shared this chart with you many times, but it presents a fundamental truth about markets. The events that cause investor uncertainty happen all the time, and then they fade from memory. Since 1980, the S&P 500 has delivered nearly 10% compounded annual returns. That's represented by the dark bars in the chart. To put it in perspective, that would turn $100 in 1980 to nearly $5,000 today. And this is all while experiencing an average drawdown of nearly 14% in each of those 41 years. We're a bit worse than that this year, but it's not out of the ordinary. Next slide. The drawdowns get your attention, but the job of the investor who wants to take advantage of the compounding power of the US markets, equity markets, is to look through adversity and maintain discipline. Here's another analysis we've shared before. Specifically, the analysis looks at money flows into and out of equity mutual funds to demonstrate the effect of market timing. It shows that the average investor fails to produce the 10% compounded returns we showed previously. Why? It's likely people tend to buy high during the good times and sell low at times of fear. This is opposite of what you want to be doing. But in the absence of having a crystal ball and perfectly timing the markets, the best approach is to be patient through periods of both fear and greed, to hold the line. That's what we're doing, and I will pass it on to Michael to talk about our portfolio positioning in this environment.
Thank you, Jack. Let's go to the next slide, please. So before discussing our portfolio, it's worth mentioning that the main attributes of our investing style are quality and value. And what we want to do next is demonstrate how quality and value protect us in this environment. So let's go to the next slide. Okay, so starting with value. What we mean by value is that we don't like to overpay for a business. The way we estimate the value of any business is by discounting future cash earnings to the present. And what the pie chart on this slide shows is that a single year doesn't affect the value of the business by that much. So if earnings in a single year decline due to a recession, then won't have a material impact on the value of the business. The other thing to remember is that we always consider all scenarios in our estimates, including recessions. We don't know when a recession will hit or how severe it will be, but we know recessions will happen, and we take them into account in our projections. Next slide, please. So now let's discuss quality and why it matters in economic downturns. So for corporations, recessions lead to lower demand and higher cost of capital. While recessions affect all businesses, some are affected more than others. Lower quality businesses struggle during tough economic conditions, and some might not even survive. High quality businesses, which are the kind of businesses we invest in, not only can survive a recession, but they can actually play offense to advance their position. So to survive a recession, a business needs to protect its earnings in the face of lower demand. Many of the best businesses have recurring revenue streams, or they sell mission critical products. So even when demand falls, these businesses don't see and meaningful, or in some cases, any declines in revenue and earnings. Examples from our portfolio include Netflix and Disney, which have recurring revenue streams, and Microsoft, Agilent, Northrop Grumman, which sell essential products. On the cost front, high quality businesses will have a more flexible cost structure than that can be right-sized if needed. Today, we already see some of the names we own slowing down spending in the face of potential near-term decline in demand. But what's really exciting to us is the offense game. It's important to own a business that can survive a recession, but what's even better is a business that can take advantage of tough economic conditions and advance its position and increase its dominance. The best businesses will take advantage of the struggles of weaker competitors to gain market share, and in more extreme cases, might even buy a struggling peer that is forced to sell. Now, good examples from our portfolio are Grainger, Ross, Ulta, and Dollar General. All of these companies gain market share from weaker competitors. And during a recession, we expect these share gains to accelerate. Let's go to the next slide. All right. One of the great advantages of our investment style is that we know what we own, which means we can go beyond sector classifications and common conventions and really dig deeper to understand our exposures and risks. One common convention that's out there is that industrials, consumer discretionary, and financials are the most economically sensitive businesses. And in most cases, it's true, but there are some exceptions. Now, about half of our portfolio is in one of these three sectors, but all of our investments are very unique and differentiated from their sector peers in a way that makes them very resilient businesses, even during tough economic conditions. So our industrial names include Grainger and Northrop Grumman. Both companies sell mission-critical products. Compared to other industrial names, demand for these businesses remains relatively stable during economic contraction. Our consumer discretionary exposure is also very unique. 4 of our names operate in the most resilient areas of consumer spending. CarMax plays in the used car space. So while new car sales tend to decline in a recession, used car sales tend to be more resilient and may even benefit from consumers trending down. You know, Lowe's, Starbucks, Ulta all sell low-cost items that are essential in our daily lives. And the sales are driven by strong personal habits, which don't change much during recessions. And then we have Ross and Dollar General, which are discount players. So both tend to benefit from consumers trending down during tough economic conditions. And in the case of Dollar General, most of the sales aren't even discretionary items, but essential consumables. Now, when investors are concerned about the impact of recessions on the financial sector, they mainly think about banks and consumer finance businesses. Our financials are very different. We own Berkshire Hathaway, which owns a large insurance business, but also many other businesses that have nothing to do with banking or consumer finance. And then we have Schwab, which has a very tiny loan portfolio in which they've never lost money. And so very different business model than the average bank. Visa and MasterCard are also considered financials, but though both play in the credit card space, they aren't involved in credit card lending. They're not even the ones that issue the cards. Card issuance and lending is done by banks, and most of the spending on Visa and MasterCard cards is non-discretionary in nature. So again, not your average financial. The most cyclical holding we have right now is Wells Fargo. But even in this case, there are some mitigating factors. Wells Fargo could not grow its loan book over the past 5 years due to regulatory sanctions. And this means that the level of risk on its books is considerably lower than the average bank that's out there. So what all of this means is that our individual holdings are very different than the average business in the respective sector. And by owning the highest quality businesses, we positioned our portfolio well for a recession. Let's go to the next slide, please. So another tool we use a lot at Summitry is stress testing. And we have several different ways we do it. In this case, we asked what will happen to our holdings if we experience the same economic conditions as we had during the financial crisis of 08 and 09. So we went back to that period and identified the businesses that experienced 5% revenue decline over the 2-year of what was the worst economic conditions of our lifetime. So these are the results of this analysis, and only 4 of our current holdings experienced 5% or more revenue decline during that terrible period. Recessions are unpleasant economic conditions. They're tough on individuals, on families. They create headwinds to businesses and uncertainty for investors. But the key takeaway here is that despite the sharp movements you see today in the stock prices, we want you to remember that what we own is the highest quality businesses we were able to find. And these businesses won't just survive a recession, but we expect them to thrive on the other end of it. Now, in the meantime, part of our job is to ensure that we are taking advantage of market volatility and potential mispricings. So I'll turn it over to Colin to discuss our recent portfolio changes.
Thanks, Michael. Let's go to the next slide here. As we talked about in the past, we view market corrections, while uncomfortable, as natural and necessary reality of investing, and they often present opportunity. So we've been relatively active during the period, during the market weakness this year. On the last quarterly call, we discussed 3 new positions that we added. These were Netflix, Taiwan Semiconductor, and Starbucks. We'll give an update on our latest thinking on Netflix since it sold off from our initial purchase last quarter. During this period, we added a new position in Amazon, and Matt will go into more detail on why we view that as an attractive opportunity. We also added to our positions in Starbucks, Agilent, and Zebra Technology, following the release of their latest quarterly earnings results. From our perspective, these are examples of where the fundamentals of the business continue to perform well, and the market sell-off provided us with an opportunity to add to our positions in high-quality businesses at attractive prices. On the sales side, we've been reducing our position in Booking Holdings and finally sold out of it completely during the quarter. Booking is a leading online travel agency and has been a primary beneficiary of the pent-up travel demand coming out of the COVID-related downturn in travel over the past couple of years. The market's been anticipating this and bid up shares to a level that we believe fully reflect this expected recovery. So we decided to sell our position and reallocate that capital into more attractive names, which included Amazon and Starbucks. We also reduced our exposure to Dollar General, Berkshire, and Ulta Beauty. All 3 of these businesses continue to perform well, but they traded at prices that we felt merited taking some profits off of the table. So I'll turn it over to Matt to share more of our thinking on Netflix and Amazon.
All right, thank you, Colin. So we didn't trade Netflix during the quarter, but we did change our thinking about how the business fits into the portfolio. Last call, we explained our decision to purchase Netflix after the stock sold off by nearly 50% from its all-time highs. We had concluded that slowing subscriber growth trends were a temporary headwind as the company digested the abnormally high subscriber growth caused by the pandemic, while the long-term opportunity to bring streaming entertainment to over 800 million global PTV households remained on track. However, our confidence in the near-term outlook has decreased as the company reported subscriber numbers and a subscriber growth forecast that were well below our expectations, causing the stock to sell off by more than 50% again. When a company shares results that are very different from what we expect, we're faced with a choice. If we determine the market is overreacting to a short-term challenge, we want to buy more. If the results indicate that our assessment of the business was wrong and our thesis is broken, then we sell out and cut our losses. But in the case of Netflix, we believe the answer lies somewhere in between. And to understand why that is the case, let's re-examine the rationale for our initial purchase that we shared on our last call. Next slide, please. So last call, we explained why we like the Netflix subscription model and its global scale, which allows the company to spread content costs on a larger subscriber base than any of its competitors. This is clearly still true. We believed that Netflix had a significant opportunity to grow their subscriber base because the service was somewhat underpenetrated in the United States and substantially underpenetrated overseas. We noted that Netflix has over 220 million subscribers, but the number of pay TV households globally, excluding China, is closer to 900 million. So while it is still true that Netflix has an opportunity to add nearly 700 million subscribers over time, the fact that growth has stalled suggests it will take longer than anticipated. And related to this, we previously argued that Netflix had untapped pricing power, given their superior portfolio of original content and higher content spend relative to competitors. However, the disappointing subscriber trends suggest that pricing power may be diminishing in more mature markets. On the other hand, while subscribers did decline slightly in the US and Canada this past quarter on a sequential basis, revenue from the region actually grew because price increases more than offset the impact of churn. So we put a caution sign next to this thesis point. Netflix management has been very clear that they will continue to outspend the competition to develop new content that both supports subscriber retention and drives new subscriber growth. We thought the business had reached sufficient scale that as this content growth slowed, revenue would continue to grow at a faster pace, leading to margin expansion and substantial cash flow generation. However, revenue growth this year and next will likely be slower than we anticipated, which means margin expansion and free cash flow generation will also be slower. So another yellow caution sign here. That said, our evaluation of management remains positive. They have a track record of strong execution and have outcompeted much larger incumbents with greater resources. Now that management has identified subscriber growth as the company's primary challenge, they have set out to address that challenge head on. Management sees two primary bottlenecks to unlocking faster subscriber growth. First, saturation in more mature markets, and second, high price points in underpenetrated markets. In terms of saturation, Netflix has about 60 million subscribers in the US, or 60 million paying subscribers, which is a market with roughly 90 million pay TV households. However, the company has identified 30 million viewers in the United States that access Netflix content through a shared password with a paying subscriber. Management estimates there are close to 100 million such viewers globally. So the good news is that these people are already consumers of Netflix content. So it is likely many will be open to paying a few dollars per month to be added to an existing subscriber account, or pay for their own monthly plan once password sharing is no longer an option. And Netflix is already running tests in South and Central America, expecting to roll out their solution to password sharing more broadly later this year. To address the price point issue, management has decided to offer an ad-supported tier for subscribers who are willing to have their experience interrupted by advertising in exchange for a lower monthly bill. Management has suggested this tier will become available sometime next year. So we think these plans make sense, and we continue to have confidence in the management. Finally, taking all of this into account, Netflix shares look attractive relative to our new assessment of their value. Next slide, please. The blue line in this chart represents our assessment of Netflix's value in the most likely scenario, while the green line shows what the business would be worth if management's growth investments were to perform much better than we expect, and the line at the bottom shows what the business would be worth in a severe adverse scenario. As you can see, the top and bottom lines haven't changed very much since our last call, but the value we ascribe to Netflix in the most likely scenario has decreased as we forecast lower subscriber growth and less margin expansion. Even against these lowered expectations, the shares look undervalued. So why aren't we buying more? Primarily, the reason is because we are less confident in our projections of subscriber growth and revenue per subscriber. So even though the business does trade towards the lower end of what we view as a reasonable range of outcomes, we think a smaller position size is warranted. Next, I will explain our rationale for initiating a position in Amazon. Next slide, please. Amazon is the dominant online retail platform in the United States, with unmatched economies of scale. Management's focus on maintaining low margins leverages this scale, making it very difficult for other businesses to compete. The retail business also benefits from strong network effects. Amazon is the leading destination for online consumers, which attracts a huge selection of third-party merchants offering a wide assortment of products, and vice versa. Additionally, management has built a retail logistics infrastructure that cannot be replicated, offering guaranteed same-day, one-day, two-day delivery, inventory management and shipping, returns processing, and more. And this infrastructure is available not just to Amazon, but increasingly to third-party merchants, both large and small. Outside of retail, Amazon AWS is the pioneer and current leader in the fast-growing market for cloud computing services. Amazon created this market, and that head start has allowed the company to build the largest user base and developer community. AWS continues to build on this lead by adding more new features than competitors who are constantly forced to play catch up. We also like that management has a long-term focus and a track record of success, and we believe the market is overreacting to short-term margin pressure caused by the company's rapid capacity expansion during the pandemic, making the current share price attractive. Next slide, please. Note the share price on this slide reflects the 20-for-1 stock split that went into effect on Monday. As you can see, we have been following Amazon closely for many years, but the price of Amazon stock has rarely appeared attractive to us. However, after the shares sold off on disappointing margin guidance, we took the opportunity to initiate a position. Essentially, new hires in warehouse space acquired to service surging demand during the pandemic became excess capacity as consumers have returned to more normal spending patterns, which is pressuring near-term margins and cash flow. However, we are very confident that Amazon's retail and logistics businesses will grow into that capacity as e-commerce continues to take share from traditional retail, and Amazon's unmatched consumer base and logistics assets allow them to take a disproportionate share of that growth. Meanwhile, the AWS cloud business continues to grow nearly 40% year over year, even after generating more than $67 billion of revenue over the past 12 months. Next slide, please. To put Amazon's valuation in perspective, if we think about the company as a portfolio of leading businesses and then compare those businesses to similar companies that trade in the public markets, we can see another view of how attractive Amazon shares appear at the current price. AWS is the current undisputed leader in cloud computing, where the number 2 player, Microsoft, trades at a valuation of 10 times trailing 12 months revenue, suggesting AWS is worth closer to $66 per share. Amazon Marketplace is a capital-light business that earns a commission of about 15% on sales completed through Amazon.com or the Amazon app. And Amazon Logistics fulfills more than half of the sales completed on Amazon and is now approaching similar scale to businesses like FedEx and UPS. Businesses like these trade for 2 to 3 times revenue. So those lines could be worth close to $26 per share. The high margin advertising business generated nearly $8 billion of revenue and grew 23% year over year in the first quarter. That's faster than both Facebook and Google, which are valued at 4 to 5 times revenue, suggesting Amazon's ad business is worth $14 per share. We think the subscription business, which includes Prime and Prime Video, is worth about $22. And the low margin first party retail business that competes with the likes of Walmart is probably worth about $24. If you add it all up, Amazon stock looks to be worth closer to $152 versus the current share price of around $120. So with that, I will turn it over to Colin for some closing remarks before we open it up for Q&A.
Thanks, Matt. I think to sum it up, we've got a diversified portfolio that we believe is well positioned, to withstand the current concerns over inflation, the conflict in Europe, and the potential slowing of the global economy. Most importantly, the recent volatility, it's allowed us to take advantage of lower prices to upgrade the quality and increase the potential long-term returns of the portfolio. So I think with that, let's open it up, Cynthia, to questions.
Great, thank you, Colin. As a reminder to our audience today, if you'd like to ask a question, please use the Q&A icon at the bottom of your screen. So to get started today, Matt, when you were sharing your comments about Netflix, one of the things you talked about was the outstanding leadership team at the company. And the question is, how much does a company's management team play into our decision-making as to whether to own a company or not?
Sure. So yeah, that's a great question. So I think Netflix management in particular, I think they deserve a lot of kudos for addressing their current challenges head on. They didn't dig in and continue to do what they've been doing in the past. They're evaluating these new options in terms of cracking down on password sharing and exploring new avenues for growth through an ad-supported tier. But I guess just in general, in terms of how we think about management, what we like to see from management is an ability to grow the per share value of their business over time. So we want to make sure they have a long-term focus, and that typically means we see that they're laser focused on building the competitive advantages that both deliver value for their customers and also protect the profitability of their business, but also maintaining that flexibility to change course in different environments, like we're seeing with Netflix. So I think another good example of that would be our experience in Northrop Grumman. So we first bought that stock back during the Obama administration, when budget concerns led the entire defense sector to sell off. The reason we like Northrop Grumman in particular is because the CEO of that company, Wes Bush, had already demonstrated that strategic flexibility by divesting some non-core assets, and also he'd announced plans to aggressively cut costs and buy back stock. So he's adapting to the environment as it was, because the company was entering a period of slightly declining revenue. But even with that slightly declining revenue, by focusing on cost control and share repurchases, they were actually able to grow their earnings per share quite significantly. So one of the executives responsible for improving that profitability during that period was Kathy Warden. And when we saw that she was promoted to CEO after Wes Bush retired, that gave us confidence to buy back into Northrop early last year when the stock became cheap again. And not surprisingly, Kathy has continued to drive margin improvement, divest some non-core businesses, and buy back stock at what we think are attractive prices. So all that's created a lot of value for shareholders.
Yeah, and I'll just, management is critical, and I'll just add that we use a quantitative tool. It's called Sustainalytics, and what that does is it gives us an assessment of the company's sort of their corporate governance policies, and it evaluates the quality and integrity of the management. The board of directors looks at their compensation practices, financial reporting disclosures, probably most importantly, how they treat their shareholders. So we use that as an overlay to complement what Matt was discussing, which is kind of our assessment and judgment of management's capabilities and track record of delivering value.
Great, thank you. So the next question speaks to how politics influence markets. Typically, this tends to be in the short term. And I think a related question to that is we've also seen some leaders of companies become more outspoken in terms of their using their platforms for politics and potentially corporate activism. Elon Musk comes to mind, maybe Disney's recent headlines. And so the question is, what is Summitry doing to protect the portfolio from some of this political volatility and activism? Just how do we think about that external factor? So Jason, maybe I'll go ahead and start with you.
Great. Thanks, Cynthia. And that's a great question as well, and a topic that's very relevant recently. So in short, we don't think businesses in general, and ours in particular, are running their businesses with a political agenda. We think managements would love to not have to make political statements that could alienate a portion of their customers, or make appearances before Congress and things of that nature. But the consumers of today expect and demand that business leaders take a stand on key issues that are important to them. So it's not that companies are choosing to get involved in the politics, it's that they have to. Now, with that said, headline risk definitely is certainly elevated compared to past periods. But we can't think of an example thus far where it had a material impact to business earnings, which drives the value of the company.
Yeah, that's a great answer, Jason. Maybe I'd just add that, while we may see some marginal impact on our businesses, what really, like Jason was saying, what really drives the performance of stocks is the performance of the underlying business. And For example, if you think about how much has been written about politics and regulation around Facebook and Google over the past few years, but you look back and Google stock has more than doubled over the past 3 years, and really none of that has had much impact on the underlying business. I mean, Facebook stock has been weaker; it's only up 10% over that period, but that's not because users have fled the platform because of politics. It's really Facebook's main challenge has been the change in the competitive landscape due to Apple's ad tracking policies. So really, at the end of the day, it's the growth trajectory of earnings and cash flow and the company's valuation relative to those that growth that drives stock prices. And for the businesses we own, politics really hasn't had a ton of impact on that.
Great, thanks, Matt. So Kurt, I want to do a little bit of a speed round with you in terms of some questions that have come up regarding some different types of holdings we might consider in our portfolios. So with inflation increasing, as you talked about earlier in the presentation, have we considered adding I bonds to the portfolio, or how do we think about that?
I think that's actually a reasonable solution. Probably best that you speak to financial advisors directly about it because of the way that you can purchase it. I think I bonds are limited in terms of how much you can purchase. I'm not an expert on it, but I think you're limited to $10,000 or something like that in principle about value. So it's not, you can't buy enough to make a meaningful difference. And I think they need to be purchased directly. And so, but I have to say, and I think this is something that is worth talking to financial advisors about, if it's whether it's a viable solution for you personally. So, not probably the full answer that you were looking for, but talk to your financial advisor.
Yeah, absolutely. And that can fulfill maybe part of the fixed income portion of someone's portfolio. So the next question is, we have seen an increase in interest rates, but we really haven't seen that hit some of the cash savings, our money market funds, our bank accounts. Any reflection on that?
I don't think it's uncommon when you see movement in interest rates in the bond markets that you don't see nearly as much movement in savings vehicles. Usually, if interest rates are declining, the banks are pretty quick to make the adjustment. They try to adjust the amounts that they're paying on their savings accounts lower sort of quickly. But when interest rates have gone up, and this is not the first time we've seen interest rates ticking upwards, bank savings accounts have typically stayed relatively low. They'll adjust over time, but expect a lag.
Okay, great. And then the last one I'll throw at you is, oftentimes during these periods, things like gold or silver might become attractive, or even including crypto, in terms of, the current state of affairs. How do you think about adding those things to a potential portfolio?
I mean, I can't advise a client how much gold or crypto or silver they should have in their personal portfolio, but I can tell you what I have, and it's zero. I don't own them. And there are probably two reasons why I could think of why someone would want to own crypto or gold. First, because ostensibly they're a hedge against inflation, a hedge against the debasement of a currency, and that's a reasonable argument. And the second reason is you'd want to own those things is because you think you can make a lot of money in it. Like you think you're going to make a ton of money in crypto, which is pure speculation. If it's the second reason that you'd be interested in owning crypto in particular, you need to look at yourself and decide how much risk you're willing to take, and have a chat with your Summitry financial advisor. They can help you through that discussion with yourself, because with crypto, you might end up with nothing. If it's the first reason that I mentioned, which is gold, silver, crypto as a hedge, here's my perspective. In my experience, the best hedge against a weak currency is a great business that provides a product or a service that's indispensable and in high demand, and a business that has a competitive edge against others who are selling a similar good or service. If the dollar depreciates, customers are going to be willing to pay more dollars for the things that they demand. So great businesses, or also well-located real estate, I mean, they've been way better investments than gold over time. And so I don't see any reason why that won't be the case in the future.
And I'll just add, I think from our perspective, it's very difficult to value an asset like gold or crypto because it's not a productive asset and that it's not generating a stream of cash flow and income that we can assign a value to. And so just kind of reiterating what Kurt's saying is, businesses that generate a stream of income that we can put a value to is something that we would prefer to own for protections against inflation.
Great, thank you. So this next question, I actually might address as a financial advisor. And the question basically asks, when there is volatility, is there a time when the portfolio is rebalanced between equities and fixed income? And does this happen automatically? Basically, what is the process for that? So I'll start by answering that we have 6 different strategies that we run at the firm, and every account at the firm is assigned an investment strategy. And these strategies vary in terms of the percent that is exposed to stocks and the percent that is exposed to other asset classes such as fixed income or cash. And so our investment team, who's here with us today, does have some discretion in terms of overweighting or underweighting within a very small band, the target percentage, say for stocks that are in any given portfolio. Typically, if we're underweighting, that underweight is held in cash. And if we're overweighting, that might include a decrease in fixed income. I can say today that we're pretty equal weighted, meaning that if a target percentage for stocks in the account is 65%, then that is about where a portfolio is today. I will say, when we go through these periods, it is uncomfortable. There's no way of avoiding that. But if you're really having struggle sleeping at night or just really suffering because of your exposure to the stock market, you can always talk to your financial advisor and potentially talk about a plan for decreasing the stock exposure in your account if that makes sense for your situation. The next question, Colin, I'd like to start with you and maybe I'll add some comments as well. But given the market decline, the question is this a good time to add to the portfolio or would you advise someone to wait?
Yeah, I think it's, again, it's a bit of a planning question as well in that, you want to make sure that the capital that you're willing to commit to your investments is long-term in nature and not short-term in nature. And so I'll also caveat that with, we don't have a crystal ball in terms of what's going to happen over the next several days or months of the market in terms of directions of the market. And so what we're doing, and you saw it in the slide, we're adding to names where we've added some new positions to the portfolio as well. And so we're seeing opportunity to put money to work in businesses that we've been following for years that quite frankly just have never screened well from a valuation perspective. And now we're starting to see those opportunities. And so we think there's, I've said this in prior calls, stocks are the only asset class that get less attractive when they become cheaper. And more attractive when they go up in value. It's not the case for anything else that I can think of. And we think it's the opposite. I think when stocks get cheaper in value is when they become more attractive, and that's when you want to be putting money to work. But so that's just from a pure opportunity perspective. And I think you have to factor in sort of your goals and objectives and time frame and the like in terms of actually additional assets to the portfolio.
Yeah, and I guess the only thing I would add is that if a client is not comfortable putting a lump sum of cash to work right away, you can always work with your advisor on a dollar cost averaging strategy to add money into the portfolio over time. And that can be effective, certainly during volatile periods where it's not the most comfortable to invest.
I'll just add one last thing, because I think we made 2 references in the prepared remarks and the slides, in that Jack showed that slide where periods of market volatility, but that what might have got lost in that is over that long period of time, the market's, returned almost over 10% per year. And then the other slides that Kurt pointed out too, in terms of sort of that recovery from the bottom of sort of the market when there's fears of a recession, it's been swift. So we don't know when that bottom will be, and we don't try and time it, but we focus on understanding what a good price to pay is for a good quality business. And as I said, we're seeing plenty of opportunities out there.
Great, thank you. So Michael, I'd like you to bring you into the conversation and address this question to you. So in looking at how our portfolio is allocated, we seem to have more in consumer discretionary as opposed to consumer staples. And consumer staples may seem to make more sense, if we are entering a recessionary period. So maybe you could speak to that. And one stock-specific question we got was related to Procter & Gamble and, maybe including that in the portfolio as a consumer staple. So maybe you could speak to that a little bit.
Yeah, sure. Of course, be happy to. So as we shared in the prepared remarks, we try to find the highest quality businesses that we can and buy them at a price that we're comfortable with. We do look at our concentrations and want to be properly diversified, but we don't focus on how the stocks will trade over a short period of time. Instead, we look at business fundamentals and make sure we are comfortable with correlations in the performance of each business with the other holdings. So the focus is on the performance of the business and not the performance of the stock in any given period. Now, with respect to the specific sector that was mentioned, I hope we were able to demonstrate today that our holdings in the consumer discretionary sector are very different than most companies in that sector and from one another. And the reason why we currently don't own much in the consumer staple space is because we haven't found anything that we think offers an attractive return. But given the volatility we see in the markets these days, that could change, and we're constantly looking for new ideas in a wide range of sectors.
Great, thank you. So I want to ask a question just about a specific holding in the account. And so I'd like to hear some current thoughts on Meta, and a couple of questions have come up specific to the company, which is how do we think about the regulatory risk of a holding like Meta? And then also if there's any comment on Sheryl Sandberg's recent announcement that she would be stepping down from the company. So Jason, would you like to start, and then I'll let others chime in?
Great, thanks, Cynthia. So maybe I'll start with the first question. I guess similar to the political question earlier, we think the regulatory risk, most of the risk is headline risk. And the reason I say that is because companies like Meta and Google are really hard to regulate. And a lot of these proposed regulations assume these companies are monopolies and hurt consumers, which we believe to not be the case. People choose to use Google search and choose to post their vacation photos to Instagram because it's a great service that people love and they're not locked in any way. So a lot of these proposed regulations globally, we think, will actually have little impact on business earnings power. And so in case of Meta, they were fined $5 billion by the FTC a couple of years ago, which certainly is a large number, but it's relatively small compared to their $100 billion in revenue last year. And then the question on Sheryl Sandberg, yeah, it's definitely something that we're watching given her tenure there and how much she's contributed to the company. We think it is still a little unclear. The reason why she left. There could be a multitude of reasons. One being, it's a tough business to run with all the attention and media today, and so it could be just it's a good time for her to step away. She's getting remarried soon, and so it could be the case where she's looking for more time to spend with her kids and her family. But I don't know if Matt has any thoughts on that.
Yeah, no, those are great. I think I might just add the company today is very different than when Cheryl joined 14 years ago, and sort of the ad and business processes and culture that she helped build are largely established. There's probably some parallel to, I don't know if you guys remember, Eric Schmidt was brought in to be the actual CEO of Google to sort of provide so-called adult supervision to Larry and Sergey, and similar to how Cheryl was supposedly the adult supervision to Mark. And I think Mark Zuckerberg's now 39 or 40. He's been running the company for a long time with Cheryl's help, and I think it's in pretty good shape in terms of the management depth they have. And you've seen some departures, but you've also seen some people boomerang and come back to the company. And if you follow closely the actual personnel changes announced in conjunction with Cheryl's departure, a lot of the hires that she brought into the company have been promoted to more senior roles, and a lot of those some of the promotions are even like the current COO, who will be taking over for Cheryl, but acting in more of a traditional COO role. He's been at the company longer than Cheryl has. So we think they have a good depth of talent, and seeing her leave after 14 years in a very strong run is not overly concerning to us.
Great, thank you. So I think we have time for one more question, and I wish we had another half hour today together, because we had a lot of good questions come through that we weren't able to get to. But I do want to let our audience know that we will be following up with you individually to answer any questions that we weren't able to get to today. And I do ask you to stay on until the end, because I do have an announcement about another upcoming webinar that we'll be hosting in a couple of weeks. But Colin, I'd like to send the final question to you. And it relates to just the short-term volatility that we're seeing in the market. And the question is whether we ever use, or how we consider maybe technical metrics such as stock price moving average in our process, and how we think about those things as it relates to volatility.
Sure. And, I think the message has been that we focus first and foremost on the fundamentals of the business. And so, the short answer is that we don't really look at the moving average of a stock. And I guess pick a number, but a 200-day moving average. And basically what that reflects is the price movement of the stock over the past 200 days. So it's a backward looking reflection. Our research is forward looking, and then we're trying to understand what the future long-term earnings and cash flow of the business will be. And because that's ultimately what's going to be the driver of business value, and that's eventually going to be reflected in the price. And so, I really think it's important to distinguish between the price of a stock, which is what we see flashing on our screens or in our statements on a day-to-day basis, and the value of the stock, which is actually the fundamental value, underlying value of what that business is truly worth, because they're two different things. And I think often in periods of short-term market volatility, there often becomes a disconnect between the value and price. So we're always focused on the fundamentals of the business and not looking at technical research, the methodology. I'll share the sort of one, I think what's a relevant quote from Warren Buffett. One of his famous lines is that in the short run, the market is a voting machine, and in the long run, it's a weighing machine. And I think it's that longer term, the weighing of what the true value is where we're focused on identifying. Because in the short run, markets and prices of businesses, they really shouldn't fluctuate at such a high degree in a short period of time, because it's the value of the business that's accrued over the long time.
Great, thank you. Well, I want to thank you all for sharing your insights today. I hope it was very helpful to our audience. So as I mentioned, our advisors will be hosting a planning webinar in a couple of weeks. It's scheduled for Thursday, June 23rd at 11 o'clock, and will be on the topic of real estate. So check your email box for more details. We hope you enjoyed today's discussion and just want to thank you for joining us and wish everyone a wonderful day. Thank you so much.